just a very brief introduction about myself. For those who do not know me, I'm Giuseppe Lombardo, and I've been working on anti-money laundering and countering the financing of terrorism for the past 20 years. I started first in the Financial Intelligence Unit of Italy, that is my own country. And then I spent almost 10 years with the International Monetary Fund, where I was employed in the Financial Integrity Network, which is a unit that at the IMF deals with matters related to financial integrity, including anti-money laundering and countering the financing of terrorism. And since 2014, I have started my own business as an independent consultant. I do work with many international organizations, but also with countries and financial institutions on AML-CFT, including on preparing them in their mutual evaluation process. When we have been trying to identify which topic to discuss today, I mean, there were several options available. Then we have chosen this one, the one on beneficial ownership, and its correlation with the misuse of corporate vehicles for money laundering, but also for terrorist financing, because it's really one of the hot topics for various reasons. First of all, you might remember the Panama Papers, but misuse of corporate vehicles, shady ownership structures, and hiding beneficial ownership are features that are there in many of the most important money laundering cases that we have been, and not just that we have seen, not just in the Panama Papers, but also in the global laundromat, and more recently in the so-called Troika laundromat, which is a big money laundering case affecting several European countries. It is also a hot topic because it presents challenges for both financial institutions and the private sector in general, but also for public authorities. For financial institutions and the private sector, because of the challenges related to establishing and verifying the identity of the beneficial owner when dealing with their customers, particularly their corporate customers, but also for the public authorities in order to ensure the adequate transparency of the legal persons that can be established in their country, which is one of the key requirements in the FATF. And last but not least, it's a hot topic because it is one of the most difficult, let's say, to in the course of a mutual evaluation. I've done several mutual evaluations myself. I've also, as I explained, assisted countries in preparing for the mutual evaluations. And it's very interesting how often this issue of the beneficial ownership is being raised and is problematic, let's say, as it affects not just recommendation 10 on customer due diligence, but also FATF recommendation 24 and 25 of the FATF on transparency on legal persons and arrangements. It's very interesting that the FATF very recently, last October, has issued a paper, a guidance on best practices on beneficial ownership for legal person. And this guidance notes that this guidance is based on the findings of the mutual evaluation reports, so on countries that have undertaken mutual evaluations. And it notes that jurisdictions finds it very challenging to have a satisfactory level of transparency regarding beneficial ownership of legal person. Now, this said, to give you a little bit of background on the choice of the topic today, I will tackle this issue by touching three different aspects. First, I will just, as a way of background information, discuss on what is the beneficial ownership. What do we mean with this term, beneficial owner? Second, I will be touching upon the findings of another FATF study, a study which the FATF has done together with the Egmont Group on the issue of concealment of the beneficial ownership, because I think that there are many interesting findings in that study which are relevant for both the private sector and the public authorities. And the third type of issue that I'm going to discuss with you what are the best approaches that particularly the private sector and financial institution can take in order to establish who the beneficial owner is, what are some of the red flags that could indicate shady ownership structures, or that the beneficial owner whom the bank may have identified at onboarding may be actually someone else. So let's start with the first issue, which is what do we mean by beneficial owner? And you may ask yourself, why am I starting with that? Because after so many years, more than 15 years that we have the requirements for financial institutions to identify and verify the identity of the beneficial owner, you will be surprised to see how many times, particularly in my meetings with the private sector, I have seen that there is some confusion, let's say, on this term. If you look at the FATF standard, of course, we know that the beneficial owner is the natural person who ultimately owns or controls the customer. What are the issues that I have seen when providing training or when assisting countries and the private sector in preparing for mutual evaluations? First of all, it is not always clear that beneficial owner does not only apply to corporate clients or to clients who are legal arrangements, such as trust, for example. The concept and the obligations related to the beneficial owner apply to any customer, because there could be, and there have been, many situations of accounts open in the name of the individual, and that individual was not the beneficial owner of the funds that were in the account. For example, because he was acting on behalf of someone else, he was a straw man to hide the true beneficial ownership. But also, if you look at other types of situations which many financial institutions encounter, let us think, for example, of bank accounts that are in the name of lawyers. Sometimes these accounts see that the funds of different clients of the lawyer are pulled together. So this is a situation whereby the beneficial owner applies also when your customer is an individual, not necessarily a corporate or a legal arrangement. The second thing that I often see, I will be speaking more also about these challenges in the third part of my intervention, is that there is an over-reliance on thresholds. For example, countries that belong to the European Union are allowed to consider those who own 25% or more of the shares or assets of a company as a beneficial owner. Although this is not explicit in the FATF, but the FATF in its mutual evaluation has basically also agreed with this approach. But it's interesting to see that in many occasions I have seen that when asking, okay, to a bank whom you consider the beneficial owner, they tell me, yes, the one who owns 25% of the share, and that's fine. But then it turns out that that one who owns the 25 of a share is another legal person, which of course is not consistent with the notion of beneficial owner, because a beneficial owner has to be always an individual. It cannot be another legal person, even if that legal person owns the 25% of the assets of your corporate client. And also, and this is particularly true in countries that are not very familiar with trusts, so particularly civil law countries, there is a little bit of confusion as to whom should be identified as a beneficial owner in the case of a trust. The FATF standard is very clear. This is not only the trustee, but it should be the settlor, the protector when one is envisaged by the trust, and the beneficiaries. So in my experience, most times I see, for example, that the financial institutions stop at the level of the trustee. They might make efforts to identify the beneficiaries, but again, the beneficiaries may not have yet been identified when the trust was established. There could be a class of beneficiary. The trustee could have the discretion, for example, at any moment in time to identify who the beneficiary is. And I find that all these details are not fully grasped by financial and non-financial institutions when they're trying to establish who their beneficial owner is. So when we're talking about the beneficial owner, it's important not only to establish the ultimate person who has not just ownership, but also effective control. So we should not focus only on the ownership, the legal ownership of a corporate client, but also on whoever has the control on the client. Which means that we should be looking at voting rights, for example, whoever has the power to appoint or remove management of the legal person. But there is another very important element which is not entailed in the definition of the beneficial owner, which is focused around ownership and control. And this has to do with who in the end benefits from the assets of a financial institution or the client. And this is actually, in my opinion, a very important element which may not be manifest at the time of the onboarding. It may only appear subsequently when the financial institution monitors the types of transactions that are being done, monitors the business relationship, that some person that may have been identified as the beneficial owner is not in fact the beneficial owner, because the purpose of the transactions is not consistent because with the knowledge that the financial institution has, and most importantly, because it's someone else who, for example, benefits from the assets of the account or the corporate client more in general. Let's move on now, having identified what are the aspects that characterize the definition of beneficial owner, to the findings of this very important study, which I encourage you all to read. It's publicly available in the websites of the FATF and of the Egmont Group. As I mentioned, this is a joint study between the FATF and the Egmont. It was published in July 2018, so it's relatively recent, but it's very important because it's based on an analysis of more than 100 real cases where there was some form of abuse of beneficial ownership and of legal persons and arrangements in general. This study demonstrates that legal persons, particularly shell companies, are a key feature in schemes that are designed to disguise beneficial ownership, while front companies and bearer shares are less frequently exploited. I find this a particularly interesting finding, particularly in reference to the bearer shares, because nowadays bearer shares, most countries have been taking measures to identify, to immobilize the bearer shares. So you really do not have anymore a true bearer share. I think only Liberia is the only country in the world that has still maintained the bearer shares. But it's important to focus on shell companies, because in many of these money laundering cases that I have mentioned to you, the global laundromat, the Troika, one of the characteristics is the use of shell companies for disguising beneficial ownership and for conducting money laundering. Also, I find it very interesting that there was a study done by the World Bank a few years before the FATF study, which is called the Puppet Masters. It's a study on more than 150 cases of grand corruption. And this study showed that these grand corruption cases shared a number of common characteristics. In particular, that a corporate vehicle was misused to hide the money trail. And in the study of the World Bank, companies are the most significantly misused vehicle that was documented in a study. So we see that we have companies as a broader category, and in the FATF study, it is the shell company in particular. Moving on the key findings that I find particularly interesting and which I think are very relevant for all who are out there participating to this webinar. Individuals and groups that seek to conceal the ownership of assets, finds the FATF, are most likely to exercise control over those assets via a combination of direct and indirect control. So in many cases, the beneficial owner will maintain some level of direct control in the scheme. For example, imagine a particularly complex ownership structure, but this is an indirect control. This is done typically through the involvement of an intermediary or straw man. Another finding of the FATF is that nominee directors and shareholders, particularly informal nominees, are a key vulnerability in the misuse of legal persons and as a way to hide beneficial ownership, and were identified in a large majority of the cases that were analyzed by the FATF study. It's interesting to understand the difference between formal and informal nominee. A formal nominee, typically a trust and company service provider, would act as a nominee shareholder or as a nominee director on behalf of the real beneficial owner. There are more chances to identify a formal nominee because, for example, a trust and company service provider is licensed, so it would be easier to verify the address. And even if there are no requirements for that trust and company service provider to disclose that is acting as a nominee, that can be more easily ascertainable than in the case of the informal nominee, which is, for example, I entrust a friend of mine or somebody with whom I am in a sentimental relationship. This sounds funny, but it has happened many times, including in the grand corruption study analyzed by the World Bank. And there is no contract, of course, as there is in the case of a formal nominee, and that person will act on my behalf, but it will not be the beneficial owner. When it comes to another interesting finding is the use of specialists and professional intermediaries as a key feature of scheme designed to conceal beneficial ownership, particularly in cases where the proceeds of crime are significant. I find it very important that this study of the FATF has identified that in the majority of the cases that were studied, these cases involved professional intermediaries. And one of the types of professional intermediaries are often involved in schemes that are designed wittingly or unwittingly to hide or to make it more difficult to identify the beneficial ownership. We find trust and company service providers, accountants, and lawyers. Let us focus on the findings concerning trust and company service providers and lawyers. The FATF has established in this study that the services provided by trust and company service providers are particularly vulnerable to exploitation by criminals involved in the misuse of corporate vehicles. It's interesting that their role is not in the design of these corporate structures. You will see that lawyers are more often involved, or sometimes also accountants more than trust and company service providers are more involved in the design of these corporate structures. But they do have a role in managing them. They may have a role in acting as formal nominees or shareholders or formal nominee directors. That's why when there are signs of an involvement of professional intermediary acting in that capacity in the management or a shareholder of a corporate entity, that should be flagged with caution, because it increases the inherent vulnerability that that particular corporate client may pose to you. The last point that I wanted to make when it comes to the key findings of this FATF study concerns the use of legal professionals and their role in facilitating schemes designed to disguise beneficial ownership, according to this study, varies depending on the situation. For example, as I mentioned before, legal professionals were more involved in the establishment of legal persons and in the management of bank accounts rather than accountants or trust and company service providers. But out of these three categories of professionals, lawyers, trust and company service provider, and accountants, the lawyers were the one more likely to be involved in the acquisition of real estate as a means of laundering the proceeds of crime and obscuring beneficial ownership. Very important, because this is an issue that comes up many times in those countries that allow accounts to be, funds to be pooled in an account without requiring financial institutions taking sufficient mitigating measures. It was found that legal trust accounts and client accounts were often more frequently used as a means of disguising beneficial ownership. This is a particularly problematic issue, because when a financial institution is dealing with an account of the lawyer, there could be cases in which the lawyer, for example, might oppose client's attorney confidentiality to the bank inquiring on to whom the funds belong. There are some countries, for example, where there is a very high risk of lawyers being used as intermediary in corruption schemes that have completely, where the banks have completely de-risked such type of accounts because of the inherent risk that they may pose for money laundering, but also for the difficulty when funds are pooled to ascertain who the ultimate beneficial owner is. So we have seen what are the characteristics of beneficial ownership. We have seen what are the major findings of this FATF Egmont study. Now, let us see what we can do about that. How can, particularly the private sector, what are the best practices out there that I see from my personal experience in dealing with banks and public authorities alike. First of all, it is important to understand that establishing the beneficial ownership, it's something that is not only required at the onboarding of the clients. It is an holistic process which requires also a proper risk assessment of the client, and most importantly, ongoing due diligence and the monitoring of the transactions that the client is undertaking. Let us focus on these three aspects because they're particularly important for our discussion. For example, one of the issues that I see all the time is an excessive reliance of financial institutions on clients' statements on who the beneficial owner is. Of course, it is important that the bank asks the prospective client who the beneficial owner is if the account will be used on behalf of the customer or on behalf of someone else. But what I often see is that the means or techniques of verification of that information are not always ideal. So that's why I say that one of the issues is the excessive reliance on the client statement. There is much more that can be done at onboarding stage. And a good practice, first of all, is not just to stop at the 25% of the ownership structure, but to focus also on who has the voting rights, who is the senior management, who has the right to appoint or remove the directors of senior or the senior management, who has the power of attorney of over an account, because these are all key features that might shed a light on the situation of the beneficial ownership. Very important when there are corporate client that presents a complex ownership structure is to understand the quality of that ownership structure. For example, and this is also something that I see very often, a bank may have as a policy to not accept customer, corporate clients when the company is, the capital of the company is represented by bearer share. But does that policy extends to all the chain of the ownership structure? Because, for example, your immediate corporate client may not have a company of bearer share, but down there at the end of the ownership structure, there could be a company that does have that bearer shares. Or, for example, and this might also affect the risk assessment of the corporate customer, certain banks who may have a more prudent approach may decide not to onboard corporate clients when these clients are established in particularly high-risk jurisdictions for money laundering and terrorist financing. But do these criteria apply all the way down to the ownership structure? So it's very important to understand the ownership structure, not just because that ownership structure might reveal an unnecessary complexity, might make it more difficult to establish who the beneficial owner is, but also because some elements of that ownership structure may present inherent vulnerabilities to money laundering, such as a particular type of activity or the country of incorporation, or, for example, because at the end of the ownership structure, we find non-operational type of corporate structures, such as for example, foundations or Anstalten, or a trust, for example. But it's also important, remember that one of the key findings of that FATF study is that shell companies are most prominent in these money laundering schemes that basically have been done, including by hiding the beneficial ownership. How do we ascertain, or are there any red flags that can tell us if the company that we are dealing with, or if any of the companies in the ownership structure is a shell company? There are many red flags that have been identified. For example, the company share had the address with hundreds of other companies. That company does not have employees. It is typical of shell companies just to have one person who does secretarial services. That as the company and a tax history, or if the company is required to file annual returns, for example, with the registry of company, can the company provide evidence of that history? These are all elements that can help. How long, for example, has the legal vehicle existed for? What is the composition of management? For example, if we have established that in most money laundering schemes involving the use of corporate entities, those entities will have directors, for example, who are overly 75 years old, pensioners, or, for example, heavily indebted or have no professional qualification, we may question whether those that have been identified as the directors of the company are the actual directors, or they're not acting on behalf of someone else. So it's very important, the second element. So the first one is proper onboarding and proper understanding of the corporate structure, including all the way down to the chain, but also the correct risk profiling of the company. And some of the red flags that I have mentioned can be used to increase, for example, the risk profile of the corporate client, so that that client will be subject to an enhanced ongoing monitoring, both in terms of periodic review of the customer due diligence, but also of transactions. And other red flags, for example, this is a good practice that I see in several banks that I've done work with. For example, more than 2 tiers of ownership structure. So company A is owned by company B, which is owned by trust C, is considered automatically to increase the risk categorization of that corporate client. But very important, and this is something that I always emphasize, is that beneficial ownership is not static concept, it's a dynamic concept. So the financial institution needs to ensure that whatever information it has acquired and it is comfortable with at the onboarding of the client remains so throughout the course of the business relationship. And the monitoring of the transactions, it's something that may shed light over situations where a person that may have been identified as beneficial owner at the outset of the business relationship ends up being not the beneficial owner because of the types of transaction that the bank, that the corporate client is doing. For example, imagine that the bank account receives large incoming transfers, and then these are immediately withdrawn with a bank balance close to zero in each of the cases, and transferred to another person consistently. That person is, I don't know, the secretary of the company, not senior management, does not necessarily qualify as that. So it's important that that may provide a red flag on as to why someone consistently receives funds that are transiting through the bank account who was not identified or provided as a beneficial owner at the outset of the business relationship. In many of the cases in the World Bank study on the grant corruption, it was very interesting that this corrupted PEPs, politically exposed person, would appear as low figures in the context of the corporate structures having a bank account. So, for example, they were appearing as the accountant of the corporate vehicle or the company secretary. So transactional monitoring is particularly important in order to understand the whether we have identified as the beneficial owner is the actual beneficial owner. Then, for example, there are other red flags that are also transactional in nature. For example, the income versus the bank deposits ratios could indicate whether the invoices a legal person is receiving are fake. Imagine a situation in which there are a lot of invoices that are billed by the legal person, but then no money gets deposited in the bank. This might indicate that fake invoices are being used for tax evasion purposes. Or, for example, getting back to an analysis that can be done at the outset of establishing the business relationship, which I've already mentioned, the income versus number of employees, because it's very likely that shell companies will not have employees, or the so-called phantom by night companies. The companies are established just for the purpose of receiving or making payments, and then are either inactive or are basically stricken off the registry. They often appear to be only on the paper with no employees, sharing addresses with several other corporate vehicles. So this was meant to be, of course, not a fully fledged discussion on beneficial ownership. There are many other aspects that we could have dwelled more in details. There could have been also, and we're happy to do that also individually with the institutions that you're representing. But I don't like this to be a one-way, let's say, sort of talk. So I think the time is right. If you have any questions, any comments that you would like to make, and I'll be happy to take them. Thank you very much for your attention.
Thank you very much, Giuseppe. Can I request the participants who have questions, please unmute your mic and ask the question, or just type the question on the chat to us, please.
Hello, Malavan.
Hey, hi, Mohammed. Yeah, please go ahead.
Thank you very much for this session. I would like to thank Giuseppe as well. It was a good one. Actually, it comes to my mind one important question, actually, concerning the monitoring of beneficiary owner. I would like to ask Giuseppe to which extent a public register, let's say, developed and deployed by the local authority or the ministry, can help the private sector to monitor and capture the beneficial owners for companies with multi-layers management level. Thank you.
Mohammed, thank you very much. This is a very good question and also a very interesting topic. My answer would be yes and no. Well, first of all, currently, the company's register, the public register, would typically have information on the legal ownership, so not really on beneficial owners. So that may not be, it might be helpful, let's say, to compare the information that is being provided by the customer and to see whether it matches the information that is available on the public registry. But to respond to your question, based on the experience of the countries that have actually established beneficial owner registers, okay? For example, in the European Union, it is mandatory for countries to establish the register of beneficial owner. In my personal experience, this, of course, is a useful source of information. But there are many downsides to this approach, because if the authority that is in charge for maintaining this register does not verify the information that is being provided, or if there are no other ways of ensuring, for example, that that flow of information is indeed maintained accurate and up to date, you may find that the information that is on the beneficial owner register to be not particularly valued from the perspective of a financial institution. And let me bring here the example of the UK, for example. Transparency International UK, and this is a publicly available study, has made a study on the information entered in the register of the beneficial owners that has been established already for a couple of years now in the UK. And guess what? They have, for example, identified that in a number of cases, the person that had been identified in the register as a beneficial owner was an infant. In one of the most famous, by magnitude of scale, money laundering case that I've seen in the Kyrgyz Republic, there were a lot of offshore companies registered in the UK, and the publicly information available on the beneficial owners pointed to persons who were deceased. So it is not uncommon that when criminals set up these vehicles for money laundering purposes, the information that they provide on the beneficial owner is not accurate. A very interesting trend which has been identified, for example, is stolen identities, or even cases in which poor persons sell their identity so that their data, their personal data, can be used for appearing as beneficial ownership in ownership structures. So there is one issue related to the accuracy of data. The second, and here I'm not divulging any confidential information because it is a published exercise. If you look at the mutual evaluation of the United Kingdom, you see that these issues are there. So the fact that they may be a public register containing even information on the beneficial owner cannot be taken for granted by a financial institution for the verification of the beneficial ownership. It might, at the onboarding, but it doesn't exempt the financial institution from applying proper transaction monitoring system so that any red flag that might indicate a potentially different beneficial owner could be identified. But thank you for that question. That's a very hot topic when it comes to registers on beneficial owners.
Thank you, Giuseppe. I will extend my question to another side, actually. When we talk about some examples concerning the offshore business, we can say the issue is how the offshore business is managed actually by the regulators in UK or in other countries, or it's on the process on how to identify the beneficial owners. So the main question here, what kind of information and of details must be supplied by the client themselves concerning the beneficial owners? So let's say, for example, I'm keeping a question on my KYC form for the client. Please, may you confirm you are the real beneficial owner?
Yes, of course.
Or you are the right party who is benefiting from the business relationship with me?
Yes.
I'm expecting an answer of yes, maybe 5,000% from all clients, if
That's
you
right.
don't mind.
Yes.
So here is my point. How can we tackle with this issue?
Yes. So again, well, first of all, I don't want to give the impression that all offshore established companies are done for money laundering purposes. There are many legitimate reasons for that. Easiness in doing business, more favorable taxable regime. Also, the cost of management of these companies may be lower than in other countries. So let us not generalize. But you raise a very good point. Of course, it's very good practice, and most banks do that, to have a KYC questionnaire in which they have in which the customer, the prospective customer, needs to state who the beneficial owner is. Now, of course, there are several ways of publicly available sources to verify that information, by verifying the address, by verifying the email, by verifying, for example, that the company has a LinkedIn profile. This needs not to be done for each individual customer, of course, because otherwise it would be too costly for the financial institution. But again, it depends on the appetite of the financial institution. You may be comfortable that the information provided is sufficient, but what I'm saying is that if you don't have a strong and solid transaction monitoring system that allows you to check the consistency of the transactions that are being done by the customers versus the information that you have established at the onboarding, including beneficial ownership information, you may have a vulnerability in that even if you do periodic reviews of the customer due diligence file, which are not tied in to the transaction monitoring, you may have blind spots which could expose you to the risk of having a corporate client or even a natural person client who may be acting for someone else. So what I typically try to ascertain when determining the level of effectiveness of how banks cope with this, whether banks have effective policies for establishing the beneficial owner is not just to focus on the onboarding, it's not just to focus on what is the information that is being collected and verified, because verification is also very important at onboarding process, but also how the bank manages the ongoing due diligence process and what are the systems in place to have transaction monitoring that might bring red flags, including on issues related to beneficial ownership.
Thank you, Giuseppe. I believe you ended your answer with a very important note concerning the red flags. And of course, red flags will differ from a banking sector to a financing institution sector and to exchange houses sector and so on and so forth. So I believe finally we are reaching one important point, which is what will be your risk-based approach to be used, and how you are going to monitor the client from onboarding to transaction monitoring and to let's say a due diligence and KYC updates for your client. Thank you very much. I'm done on this area. I will leave the space to my colleagues to go and discuss further with you. Thank you, Joseph.
Thank you very much for your questions. They're very good points.
Can I request anyone else to ask the questions, please? Other than Mohammed Guzail, please.
Hi, this is Athar.
Hi, Athar.
Yeah, Mr. Joseph, I just want to ask about the bearer shares and type of bearer shares, because in our country, it is not very much means common type of share holding. So if you can just put some light on it, on this topic, how this could be used in hiding the UBOs.
Yes. So basically, by bearer share, we mean a share that entitles ownership, including voting rights, to whomever is in the possession of the share. So basically, the share will not have a name of it. That name will not be entered in the shareholder registries, okay? But the share rights are given to whoever is the bearer of the shares. Now, because, so you can understand that this favors potential anonymity and also issues of beneficial ownership, because I could give those shares to someone else who could go and exercise voting rights in the general meeting of a company on my behalf. If you look at the records of the general meeting of the company, the name that will appear there will be of the person who was bearing, who was possessing the share, but not of myself. So I must say, and just in case it was not fully clear, I would like to re-emphasize it, that many countries, the majority of countries now, who allow bearer shares, they have introduced regimes to mitigate the risk that this share may pose. For example, by requiring that the shares be immobilized with a custodian. The custodian is typically a professional who is subject to KYC requirement. So that custodian will know who the owner of the bearer shares is. This is called a dematerialization of the bearer shares. So nowadays, the risk of dealing with a company who has bearer shares, if these mitigating measures are in place, the dematerialization, are less susceptible to money laundering risk than there was in the past. I think that even the British Virgin Islands, which until very recently allowed bearer shares, have transitioned to their dematerialization in order to decrease their vulnerability to money laundering abuse. So this is what we mean by bearer share. Of course, if your country requires that the share be nominal, so be in the name of someone, there cannot be such a thing as a bearer share. A bearer share cannot exist as a customary practice. It must be allowed by the law of a country. So if no such instrument exists in your country, then the only risk that if you're a representative of a financial institution, the only risk of encountering a corporate client with a bearer share would be if the corporate client is a foreigner, or if in the ownership structure of a corporate client, we have another corporate client which has bearer shares in its corporate structure.
Okay, thank you very much, Mr. Joseph.
You're welcome. Thank you.
Joseph, Mohammed Dindar has a question. Mohammed, please go ahead.
Mohammed, yes.
Mohammed, please go ahead. You just have to okay, let me unmute your mic.
Thank you, Giuseppe, for that presentation. There was a lot of useful information there that we can take away. I just want to bring you back to the basic question of the beneficial ownership rule, which states that financial institutions must verify and identify each natural person with 25% or greater equity interest in legal entity customers. For mutual evaluation purposes and other issues, what happens? Are financial institutions expected to collect information as well under 25% ownership? Will they be complying if they don't? Or does it depend on the risk assessment of each country?
So that's a good question. I'll answer it from a more general and then a specific approach. From a more general approach, let us remember that the beneficial owner is the person who ultimately owns or controls the company. So the threshold has been accepted, so to speak, by FATF just as at a minimum, let's say. But if the financial institution suspects that someone else is having ultimate control on the corporate client, even if it's not owning 25%, then there should be a legal requirement for that person to be identified and verified as a beneficial owner. There could be also other situations in which you don't have someone with 25%, and this is a specific example. Imagine a company that is owned by 5 persons and everyone has 20% of the shares. At onboarding, I would consider each of them as beneficial owner because you're equal, but this is a case in which 25% is not reached. So from a perspective of a mutual evaluation, technical compliance-wise, it's okay if the country establishes threshold that may be deemed to be a beneficial ownership situation, like the 25% or lower. But from an effectiveness perspective, so I'm talking now about immediate outcome number 4 particularly, if in a meeting, and I'm speaking here with 2 hats, the hat of the mutual evaluator, because I've done mutual evaluation, but also the head of those who prepare countries for mutual evaluation, because in that context, I do a lot of mock interviews. So from an effectiveness standpoint, if as in this capacity as an evaluator, I realize that the bank would always stop at the 25%, would make no efforts in establishing situations where there is not a situation of formal ownership, but of ultimate effective control. That the bank over-relies, for example, on client statements without verifying that information, even by applying a risk-based approach to the verification of the information. If the bank doesn't have a transaction monitoring system that is not only aimed at red flags for suspicious transaction reports, but also in general to make sure that the information that it has obtained on customer due diligence at the onboarding remains consistent, that in my opinion would raise an issue of effectiveness which might affect immediate outcome number 4, even though the legal framework from a technical compliance would present no issues because this now has been accepted by FATF, the 25%.
Okay, thank you very much for that, Giuseppe.
Thank you, Mohammed. Any other questions, please?
Uh, Malavan.
Please go ahead.
Actually, I will just ask Giuseppe his views concerning the latest FATF evaluation report related to UAE, if he had the time to look on it. I know this is out of our agenda, but just from his experience perspective, if he can give us some highlights concerning this report. Thank you.
It's not that I don't want to answer the question, but because we're talking on a webinar that is very regional, I would not feel comfortable in making comments on countries in the region, but that's a publicly available report, so the findings are out there. So it's not an excuse not to answer the question, is I think that I'm comfortable with other countries that are not necessarily in the region.
Thanks, Giuseppe.
Thank you, Giuseppe.
You didn't put me in trouble.
But it's a public report, so it's out there.
Giuseppe, it seems that it was my mistake. I have to ask the question in another way. I will do it next time, no worries.
Next time, by all means.
I think I have to register my company outside the Middle East to make life easier.
Thank you, Giuseppe. Many thanks.
Thank you so much.
Any other questions before we wind up?
If there are no other questions on my behalf, Malavan, let me just briefly take this opportunity to thank everyone. It was great seeing you all out there, particularly in these times. It's extremely rewarding to see that despite the challenges, we do our best to keep up on top of these things when there are also other important issues arising from the pandemic. So thank you very much. Thanks also to all who have intervened with their very stimulating questions, which have added a lot to the discussion.
Thank you very much, Giuseppe. Thank you everyone for joining our webinar. Please be in touch with us. There are more programs coming up, especially for banks and financial situations. If you do not have my email ID, or you can just, I think everybody has my email ID. If you have registered via LinkedIn, just text me your email ID so that I can send you the recording of this webinar to you. Thank you very much.
Thank you. Bye-bye.
Thank you.
Thank you.
Bye.
Bye-bye.
Thank you. Bye-bye. Bye.
Bye.
Thank you.